The trade that hurts your account is rarely the one that destroys it. It's the extra few cents of hesitation before an exit, the slightly larger position you justified because you felt confident, the stop loss you moved, just this once. Those decisions seem too small to matter. Yet weeks later, you look at your results and wonder where the damage came from. And here's the uncomfortable part. The market often punishes tiny mistakes long before it punishes big ones. Have you ever reviewed a losing week and noticed there wasn't a single catastrophic trade? Just a collection of small decisions that slowly pulled you off course. That's because trading is a game of accumulation. Small actions compound. Small errors compound too. A trader usually doesn't wake up one morning and suddenly become undisciplined. The process is much quieter. One rule gets ignored, then another. A little impatience enters the decision-making process. A little certainty replaces curiosity. The account reflects those changes long before the trader notices them. Why does this happen? Because the market responds to behavior, not intention. You can intend to be patient. You can intend to manage risk. You can intend to follow your plan. But your results come from what you actually do when money is on the line. Think about it. What happens when you enter trades a few minutes too early? Your stop gets wider. Wider stops require smaller positions. Smaller positions reduce efficiency. One small adjustment creates a chain reaction. Cause leads to effect, effect leads to another effect, and eventually the outcome looks completely disconnected from the original mistake. But it wasn't. The same principle works in your favor. What if you improve just one behavior? Not 10, just one. Suppose you wait for confirmation instead of anticipation. Your entries improve. Better entries reduce emotional pressure. Reduced pressure makes it easier to follow your plan. Better execution improves consistency. One adjustment creates a completely different chain reaction. Notice what changed. The market didn't change. The strategy didn't change. You changed. This is why experienced traders spend so much time observing themselves. They watch where impatience appears. They watch where confidence becomes overconfidence. They watch the moments when emotions try to disguise themselves as logic. Have you noticed that your biggest mistakes often feel reasonable in real time? That's what makes them dangerous. The goal is not to eliminate emotion. The goal is to recognize its fingerprints before it influences your decisions. So start looking for small signals. Look for the extra click before entering a trade. Look for the urge to move a stop. Look for the need to recover a loss quickly. Those moments appear insignificant, but they reveal the habits that eventually shape performance. Trading rewards attention to detail because details become behavior, behavior becomes consistency, and consistency becomes results. The trader searching for a breakthrough often overlooks the fact that breakthroughs are frequently hidden inside ordinary decisions. A slightly better entry, a slightly smaller loss, a little more patience, a little less ego. You can spend hours analyzing a chart, identify the right setup, predict the right direction, and still damage the trade in the final few seconds. That sounds strange until you look closely at execution. A trader sees price approaching an entry level. The setup is almost complete. The market needs one more push, one more confirmation, one more piece of evidence. But instead of waiting, the order is placed early. Maybe it's only a few seconds early. Maybe it's only a few ticks away. It feels insignificant. Yet that small difference often separates a clean trade from a difficult one. Why? Because execution is where analysis meets reality. The chart may suggest an opportunity, but the entry determines the actual price paid for that opportunity. A slightly early entry changes the structure of the trade. The stop may need to be wider. The risk may increase. The reward to risk ratio may weaken. The trade now carries different characteristics than the one originally planned. Nothing dramatic happened. Just a small loss of precision. But markets have a way of magnifying small losses of precision. Have you ever noticed how often a trade moves against you immediately after entry, only to work perfectly a few moments later? The setup wasn't necessarily wrong. The timing was. That distinction matters. When execution becomes sloppy, traders often blame the market. They say conditions changed. They say volatility increased. They say the setup failed. Sometimes the simpler explanation is that they entered before the market revealed what it was about to do. The market is constantly providing information. Every additional moment allows new information to appear. A breakout either holds or fails. A level either attracts buyers or rejects them. A trend either continues or weakens. When you enter too soon, you voluntarily trade with less information. Less information creates more uncertainty. More uncertainty creates poorer positioning. Poorer positioning creates weaker outcomes. The chain begins with a tiny decision that hardly feels important at the time. Now consider the opposite approach. A trader decides to wait until every condition is satisfied. Not almost satisfied, not likely satisfied, actually satisfied. The difference may only be seconds. But those seconds force the market to prove itself. And when the market proves itself, execution becomes more efficient. Entries become more precise. Stops become more logical. Risk becomes easier to define. Notice that nothing changed about the strategy itself. The edge was already there. The improvement came from allowing the edge to express itself more clearly. This is one of the quiet truths of trading. Better execution does not always mean finding better trades. Often it means participating in the same trades with greater precision. The market pays attention to precision. A small delay can eliminate a poor entry. A small improvement in entry can reduce risk. Reduced risk changes the quality of the entire position. And when that process repeats hundreds of times, what originally looked like a tiny adjustment begins producing noticeably different results. So start observing the moments immediately before execution. Not the trade, not the setup, the final moments before the order is placed. Ask yourself a simple question: am I entering because the market has confirmed what I need to see, or because I want to be early? That question sounds small. A trader can double an account with one exceptional trade. Everyone notices that. What receives far less attention is the trader who improves an edge by a small amount and quietly transforms years of results. The first outcome is dramatic. The second is powerful. And the market has a habit of rewarding the second more consistently. Have you ever wondered why some traders seem to make progress without any spectacular wins? The answer often has less to do with individual trades and more to do with small advantages repeated over and over again. In trading, people naturally focus on large outcomes because large outcomes are easy to see. A huge winner stands out. A sudden gain attracts attention. But markets operate through repetition. A trading edge is not a prediction. It is a small statistical advantage expressed across many opportunities. That word, small, is important. An edge does not need to be enormous to become valuable. In fact, some of the most powerful edges appear insignificant when viewed one trade at a time. Imagine a trader whose method performs slightly better than random market participation. Not dramatically better, just enough to create a modest advantage. One trade reveals almost nothing. 10 trades reveal very little. But as opportunities accumulate, the advantage begins expressing itself repeatedly. Small gains appear more often than small losses. Positive outcomes begin outnumbering negative ones. The difference may be narrow, but repetition keeps applying pressure in the same direction. The effect grows because each occurrence adds to the previous one. This is where many traders become impatient. They expect a large edge to create immediate evidence. The market rarely works that way. Small edges require time because their strength comes from frequency, not intensity. A large win can change a month. A small edge can change a career. There is an important distinction there. Large wins depend on rare events. Small edges depend on common events. Which do you think offers more opportunities for accumulation? The mathematics of trading quietly favors repetition. Every time a positive edge is applied, even by a narrow margin, the account moves slightly closer to favorable territory. The movement may be difficult to notice at first. But markets do not care whether progress feels exciting. They only respond to the arithmetic. A trader who seeks dramatic gains often ends up depending on exceptional circumstances. A trader who focuses on small edges depends on normal circumstances, and normal circumstances occur far more often. That is why modest improvements deserve serious attention. A slightly higher quality setup, a slightly better risk to reward profile, a slightly improved entry price. Individually, these changes appear too small to celebrate. Collectively, they begin shifting probabilities, and once probabilities shift, outcomes eventually follow. The key is learning to evaluate progress differently. Instead of asking, "Did this trade make a lot of money?" ask, "Did this trade express my edge?" Those are very different questions. One measures isolated results. The other measures the quality of the underlying advantage. Over time, the market tends to reward the second question more faithfully than the first, because a trader who consistently strengthens a small edge is improving the engine that produces future results. The individual trades remain uncertain. The edge remains small, but each repetition gives that edge another opportunity to work. One of the most expensive assumptions in trading is believing that accuracy is the thing the market rewards most. At first glance, it seems obvious. If you can predict direction correctly, you should make money. If you predict incorrectly, you should lose money. But spend enough time around the market and you'll notice something unusual. Some traders are right often and struggle to grow. Others are wrong regularly and continue progressing. How can that be? Because markets do not reward isolated acts of correctness. They reward behavior that can be repeated under changing conditions. A trader can make an accurate prediction by accident. A trader can guess the next move correctly. A trader can even string together several correct forecasts. But the market has no obligation to reward a process that cannot be repeated. Consistency is different. Consistency is not about knowing exactly what happens next. It is about interacting with uncertainty in the same disciplined way over and over again. That distinction changes everything. Think about a market participant who catches a large move through exceptional timing. The trade works. The prediction proves correct. The result looks impressive. But if the outcome depended on circumstances that rarely occur, what value does that accuracy have in the future? The market constantly changes character. Trends strengthen and weaken. Volatility expands and contracts. Conditions evolve. An approach built primarily on being right must constantly prove itself again. An approach built on consistency survives those changes more effectively because it relies on repeatable behavior rather than exceptional forecasts. Have you noticed that markets rarely pay traders for being right once? The real reward comes when the same process can function across dozens, hundreds, or thousands of opportunities. That is where consistency becomes valuable. Consistency creates reliability. Reliability creates predictability. Predictability allows performance to accumulate. Without consistency, even accurate decisions become isolated events. This is why the market often appears unfair to traders who focus only on prediction. They remember the correct forecast that produced little reward. They remember the inaccurate forecast that somehow created profit. The market is not grading predictions. It is evaluating how actions perform across repeated encounters with uncertainty. A single outcome reveals very little. Repeated outcomes reveal everything. Once you understand this, you begin viewing market behavior differently. A market trend does not reward you because you identified it once. It rewards you because you continue responding to similar conditions in a dependable way. A range does not punish you because it exists. It punishes inconsistency in how you interact with it. The market keeps asking the same question in different forms: can this behavior be repeated? If the answer is yes, the market tends to provide opportunities for that behavior to compound. If the answer is no, results become dependent on circumstance. And dependence on circumstance is a fragile foundation, so pay attention to what the market repeatedly rewards. Not the spectacular trade, not the extraordinary prediction. Look for the behaviors that continue functioning regardless of whether the last trade was a winner or a loser. Look for actions that remain useful when conditions shift. Look for patterns that produce similar responses from you every time they appear. The market has a remarkable way of exposing anything built on occasional brilliance, but it quietly supports what can be repeated. The trade you take is often decided long before you click the button. That may sound strange because the visible decision appears to happen in a single moment. Price reaches a level, a setup appears, and you either enter or stay out, but the real decision usually starts much earlier. There is a decision before the decision. A trader begins the day expecting action. That expectation influences what gets noticed. What gets noticed influences what gets considered. What gets considered influences what eventually becomes a trade. By the time the order is placed, much of the process has already occurred. The final decision is often the result of a chain that started several steps earlier. Have you ever looked back at a questionable trade and wondered, why did I even consider that setup in the first place? That question points towards something important. The quality of a decision is heavily influenced by the conditions that existed before the decision was made. Markets present endless information. No trader can evaluate all of it equally. Attention must be directed somewhere, and wherever attention goes, opportunities begin to appear. If your attention is directed toward finding reasons to trade, you will discover them. If your attention is directed toward evaluating quality, you will discover something entirely different. The market itself may remain unchanged. The decision process changes because the focus changes. This is why small shifts in thinking can create large differences in results. A trader who asks, "How can I participate?" receives one set of answers. A trader who asks, "Does this truly deserve participation?" receives another. The chart is the same, the information is the same, but the initial question alters the path that follows. Cause creates effect. The earlier decision shapes the later decision. This happens constantly. A trader decides that every market move requires a response. That belief increases activity. Increased activity creates more opportunities to force trades. Forced trades create weaker selections. The visible problem appears at the end of the chain, but the real cause existed at the beginning. The opposite is also true. A trader decides that opportunities must earn attention rather than receive it automatically. That decision changes observation. Different observations produce different conclusions. Different conclusions produce different actions. Again, the visible trade is only the final expression of an earlier choice. This is why strong decision-making rarely begins at the point of execution. It begins with the standards that determine what deserves consideration. The market constantly offers possibilities. The challenge is deciding which possibilities deserve mental energy. That choice seems small, yet it quietly influences every decision that follows. Think about how often traders evaluate outcomes without evaluating filters. They focus on whether a trade worked. Less attention is given to why the trade entered the decision-making process in the first place. But filters shape options. Options shape decisions. Decisions shape results. The sequence matters. If weak opportunities consistently enter the decision process, the quality of decisions naturally declines. Not because the trader lacks intelligence, not because the trader lacks effort, because the pool of choices has already been compromised. So begin observing the earlier moments. Observe what captures your attention. Observe what qualifies as an opportunity. Observe the standards that allow an idea to move from observation into consideration. The market is constantly asking for decisions, but the most influential ones are often invisible. They happen before any order is placed. They happen before risk is accepted. They happen before profit or loss becomes possible. Professional traders are often recognized by their results. The interesting part is that their results are usually built on routines that appear too ordinary to matter. A few minutes spent reviewing markets before the session. A written record after a trade. A consistent preparation process. A structured review at the end of the week. None of these activities look impressive. None generate immediate profit. Yet over time, they create a noticeable separation between professionals and everyone else. Why? Because professionals understand something that is easy to overlook. Performance is not created only during market hours. It is created by the habits that surround market hours. A trader who arrives unprepared enters the session dependent on whatever happens next. A trader who arrives prepared enters with context. Context improves observation. Better observation improves interpretation. Better interpretation improves action. The market may be identical for both traders, but the quality of interaction is different because the preparation was different. The effect begins before the first chart is analyzed. Have you ever noticed how small tasks become easier when they are performed consistently? The same principle applies to trading. When preparation becomes routine, Less energy is spent deciding how to prepare. When review becomes routine, less effort is required to identify patterns. When record-keeping becomes routine, information accumulates naturally over time. Each habit reduces friction. Reduced friction increases consistency. Consistency improves the quality of work. The improvement does not come from a single breakthrough. It comes from removing small obstacles that repeatedly interfere with performance. That is what makes professional habits so powerful. They solve recurring problems before those problems appear. Consider the trader who documents observations every day. The individual notes may seem insignificant. One day reveals very little. A week reveals a little more. Months begin revealing patterns that would otherwise remain invisible. The habit creates a growing collection of evidence. Evidence improves understanding. Understanding improves future actions. The value is not found in any single entry. The value emerges through accumulation. This is how many professional routines operate. Their importance is difficult to see in isolation. Their importance becomes obvious when repeated. Another interesting characteristic of professional habits is that they reduce dependence on memory. Memory is selective. Memory changes. Memory often highlights unusual events while ignoring ordinary ones. Habits create records. Records preserve reality, and reality is usually more useful than recollection. A trader who relies entirely on memory is forced to guess what happened. A trader who maintains habits can verify what happened. That difference may appear small, but it changes the quality of future decisions. Professionals place enormous value on reliable information. Habits are one of the most efficient ways to create it, so pay attention to the routines that seem too simple to matter. Pay attention to the tasks that feel repetitive. Pay attention to the activities that produce no immediate reward. Those are often the habits being ignored by traders searching for dramatic improvements. The market has a way of rewarding preparation quietly. Not in a single day, not in a single trade, but through a gradual accumulation of advantages that begin forming long before an opportunity appears. The difference between an average trade and an exceptional trade is often not the entry, it is what happens after the entry. A trader can identify the right opportunity, enter at the right place, and still leave a surprising amount of value on the table through a small adjustment made later. Trade management is full of these moments. A stop moved slightly too soon. A position reduced a little too early. A winning trade closed at the first sign of movement instead of being allowed to develop. The adjustments appear minor. The consequences are not. Have you ever looked back at a chart and realized the market did exactly what you expected, yet the profit captured was only a fraction of the move? That experience reveals an important truth. Finding opportunities and extracting value from opportunities are not the same thing. The market can offer a large move, but the trader still has to remain aligned with it. And that alignment is often determined by small management decisions made after the trade begins. Once a position is open, a new challenge appears. The market starts providing fresh information. Price moves up. Price moves down. Momentum increases. Momentum slows. Every movement creates an opportunity to react. The temptation is to treat every new piece of information as a reason to adjust something. But frequent adjustments create a hidden problem. Each adjustment changes the original structure of the trade. The more often the structure changes, the more difficult it becomes for the trade to express its full potential. Cause leads to effect. A small adjustment reduces available room. Reduced room increases the probability of being removed from the trade. Early removal reduces exposure to larger movements. The final outcome appears disappointing, even though the original analysis may have been correct. The entire chain began with a seemingly harmless adjustment. This is why experienced traders pay close attention to management decisions. Not because every adjustment is wrong, because every adjustment carries consequences. A position cannot simultaneously have maximum protection and maximum opportunity. Every management choice creates a trade-off. The question is whether that trade-off is improving the position or limiting it. Consider what happens when a trader repeatedly exits winners at the first meaningful profit. The individual decision feels responsible. Profit is secured. Risk disappears. Nothing appears wrong. Yet over time, a pattern develops. Smaller gains are consistently captured. Larger gains are consistently missed. The distribution of outcomes begins changing. Not because the market changed, because the management process changed. A tiny adjustment repeated across many trades gradually reshapes overall performance. That is why trade management deserves careful observation. The goal is not constant intervention. The goal is understanding the impact of intervention. Every action alters the future path of the trade. Every adjustment influences what remains possible. The market does not simply reward being right. It rewards staying aligned with opportunity long enough for opportunity to reveal itself. Sometimes that requires action. Sometimes it requires restraint. Knowing the difference becomes increasingly important as experience grows. So begin studying the moments after entry. Observe when adjustments occur. Observe what information triggered them. Observe whether those adjustments improved the outcome or simply changed the outcome. Many traders spend years searching for better entries while overlooking the fact that a significant portion of performance is determined after the trade is already open. Very few trading mistakes arrive wearing a warning sign. The costly ones usually arrive disguised as exceptions. Just this once. Those 3 words have probably done more damage to trading accounts than many market events. Not because the decision itself is always catastrophic, because the phrase changes the relationship between rules and behavior. A trader creates a process for a reason. The process exists to guide action when uncertainty is present. Yet the moment, just this once, enters the picture, the process is temporarily suspended. The exception becomes more important than the standard. And that is where the problem begins. Have you noticed that most damaging mistakes rarely start as habits? They start as isolated incidents. One trade taken outside the plan. One rule ignored. One exception justified. The individual action appears harmless because it is evaluated independently. But markets rarely punish isolated actions immediately. Instead, they influence behavior. Behavior influences repetition. Repetition influences outcomes. The danger is not the single exception. The danger is what the exception teaches. Every action sends a message. When a trader breaks a rule and experiences no immediate consequence, an important lesson is absorbed. Not necessarily a correct lesson, simply a lesson. The mind begins treating the exception as acceptable. What was once unusual becomes easier to repeat. What becomes easier to repeat becomes more frequent. The visible mistake occurred once. The real impact begins afterward. This is why small violations deserve attention. Not because they guarantee failure, because they quietly alter standards. Standards determine behavior. Behavior determines results. The chain is longer than most traders realize. Imagine a trader who slightly exceeds a position size limit. The trade works. Nothing bad happens. In fact, extra profit is earned. On the surface, the outcome appears positive. But something important has changed. The rule no longer feels absolute. A new possibility has entered the decision-making process. The next exception becomes easier. Not because circumstances changed, because the standard changed. This is how many common mistakes grow. Not through dramatic acts of recklessness, through gradual normalization. A small exception becomes familiar. Familiarity reduces resistance. Reduced resistance increases frequency. Frequency transforms an exception into behavior. The market eventually encounters the new behavior and responds accordingly. By then, the original mistake is often forgotten. Only the consequences remain visible. What makes this process difficult to detect is that the first exception rarely feels significant. In fact, it often feels reasonable. That is precisely why it is dangerous. The mistakes that deserve the most attention are not always the largest ones. They are often the ones capable of changing future behavior. A mistake that costs money once is unfortunate. A mistake that changes standards can influence hundreds of future decisions. The second type deserves far more respect. So begin paying attention to the language that appears around mistakes. Listen carefully for the phrases that justify exceptions, the explanations, the special circumstances, the reasons why normal standards supposedly do not apply. Those moments reveal something valuable. They reveal the point where behavior is attempting to separate itself from structure. And every time that separation occurs, a choice appears. Not a choice about a trade, a choice about a standard.